Another wave of inflation is about to hit the US economy. ISM PMI reports for manufacturing and services just dropped this week, and they're flashing major signals for both inflation and growth in the US economy. Let's take a look. Remember that the vast majority of GDP in the US economy comes from services. Here we can see about 73% versus manufacturing, which only makes up about 10%. Now, remember, with these PMI reports, anything above 50, which is going to be the pink line in the next two slides, anything above 50 indicates that that particular area is expanding in expansionary territory, generally a sign of strength and growth. Anything below 50 is contraction territory, indicating again economic weakness in that particular area. Now, starting with manufacturing, here we're looking at the overall index. And it has been in contractionary territory, although improving going back to early 2023. There is a bit of a caveat with this index alone, which is anything above 42. ISM says that anything above 42 for this index generally indicates that the US economy is doing just fine. And sure enough, we are well above 42 because remember, only about 10% of the US economy is manufacturing. Moving on to employment, this looks quite weak. ISM manufacturing employment has been weak for the past 2 years or so. Moving on to ISM manufacturing new orders. These had started to peak into expansion territory last month. However, we are down to 48.9, indicating some weakness since last month. And as you can see, has been bouncing around 50 going back the past year or so. However, the real signal here is in manufacturing prices, which have been moving sharply higher going back to early 2023 or so. Now, we'll see why this matters in a second, but this is one of the highest signal, as we'll see. So here's ISM services. Again, 70% of the US economy is services. Here, again, we're looking at prices, and it's the same story, which is prices as measured by the Purchasing Managers Index conducted by ISM is sharply higher. It is well into expansionary territory at 69.4 for, again, ISM services prices. Now, new orders, these are again down sharply from last month, but still in expansionary territory. And finally, if we move on to employment, this is in contraction, up ever so slightly from last month. I would say this looks a lot better than ISM manufacturing employment, but still pretty weak. And of course, we do know that the labor market is weakening. So here's ISM services business activity, generally pretty strong. We can see this has been holding up basically above 50 going all the way back to 2020, excuse me. So here is why it matters. Here's real GDP, a year over year rate of change of gross domestic product, or the total economic output of the US economy. And we're overlaying ISM services, again, 70% of the US economy. We're overlaying that with real GDP. And we can see a very, very striking correlation, but it actually gets even stronger. So if we take a 3-month moving average to smooth out some of the month to month volatility with these ISM reports, we can see an even stronger correlation. And finally, if we push that moving average forward by 2 months, we get an even better correlation. So you can see that these bottom almost exactly at the same time in both .com, 2008, and 2020. Now, ISM new orders for services, again, 70% of the US economy, is in expansionary territory and heading up over the past 2 months. So generally, this is a good signal for real GDP. Now, moving on to inflation, as you probably recall, both manufacturing and services, the prices element, were both well into expansion territory. Well, here we're taking a look at CPI inflation. Now, remember, most consumers, they do not think of or experience inflation as a year-over-year rate of change, but that is how economists talk about and measure inflation. So that is what we're looking at here, is a year-over-year rate of change of consumer prices. And sure enough, as you can see, another striking correlation between CPI inflation and ISM services. However, it gets even better if we take moving averages. So here I'm going to put a 12-month moving average on both CPI and ISM services. And again, the correlation gets even better, adjusting for some of that volatility. But it gets even better if we push that forward, that moving average forward by 2 months. What this indicates is that ISM services prices, with about, again, a 2 month lag or so, which is identical to the lag that we gave here when it comes to real GDP or inflation adjusted growth, with about a 2 month lead time, we can see what inflation is going to be, generally speaking. It's not a perfect one-to-one correlation. It's not a guarantee, but as you can see, the correlation is quite striking. So again, as both ISM services and manufacturing, the prices element that is surveyed in each of those two surveys, both of them indicate higher prices, well into expansionary territory, indicating that inflation is very likely to start to pick up again. Now, I thought it might be good to take an average of both manufacturing prices and services prices. So, what I did is took an average of the two of those indexes. That is what we are looking at in white. And then, of course, in red is the CPI inflation rate. And again, no moving averages here. Hopefully, the correlation is quite clear, which is with about a 2 month lead time, we can see what inflation is going to be. And we know inflation is already hanging out around 3%. If you look at core CPI, that is at 3.1. And if you look at core PCE, that is at 2.9. So inflation is already quite elevated. And what both manufacturing and services are indicating with their prices paid element is higher prices, whether it be manufacturing or if we look over here at services. And again, the correlation is quite clear. Once you kind of smooth out some of the month to month volatility, hopefully that correlation is quite clear. And what it is indicating is that there are higher prices ahead. Price pressures, if anything, inflation is probably going to go up, not down. That is what these various PMI reports are telling us, with, again, about a 2 month lead time. And the same is true for real GDP, or inflation adjusted gross domestic product. Again, the total economic output, aggregate economic output of the US economy, generally looks pretty good for ISM. If we overlay again the ISM services new orders with real GDP, again about a 2 month lead time, we can see that it is very strongly correlated with real GDP. And again, remember that services is about 70% of the US economy. So probably the more important one to look at, although of course manufacturing does play somewhat of a significant role at about 10% of the US economy. So anyways, hopefully that was helpful. Higher inflation, probably higher real GDP, higher nominal growth, which has been the call here since May or June. That so far has proven correct, and we are very likely to see higher inflation again from an elevated base. We only got down to about 3%, which is nowhere near the Fed's target of 2%. Again, it's a long run target, but nowhere near that 2% target. They started to cut rates at the end of September, or the end of 2024 in September, and they've been cutting ever since, despite the fact that you have assets at all-time highs, whether it be home prices, whether it be the stock market, whether it be gold, and of course, weakening labor market is their excuse. But inflation is 3%, and they're still cutting rates. They've cut rates with inflation basically at 3%. They've done it 3 times now. So very clearly, they do not really care about the average American who is suffering under higher costs. And again, these ISM PMI reports indicate that those costs are only going to get worse. Anyways, hopefully that was helpful, and I will catch you on the next one.